Good morning. I'm Maurice Crespi. I'm the managing partner of Schindler's Attorneys. Schindler's Attorneys are a co-founder, excuse me, of COBRA. COBRA is South Africa's largest pro bono corporate initiative. The idea behind COBRA is that we help businesses in distress wherever we can. We've assembled a team of professionals, various companies, from Microsoft to assisting, to R&B, to Schindler's Engaged Business Turnaround. And today we are being assisted by Nuecapital in relation to the presentation today, which is changing capital the raising landscape in SA for stressed businesses and who will attract capital. These type of participants in COBRA have pledged, so the likes of Nuecapital, who are specialist advisors, have pledged to actually assist businesses where they can in their time of need on the basis of the pro bono pledge that's set out in our COBRA website, and all the details are there. Now, COBRA is providing pro bono services not only by the provision of these webinars, but also by having compiled a knowledge database on the COBRA website. It's www.cobra.org.za. We're told that it is the most impressive and detailed database in South Africa. So have a look at that. Then when it comes to actual services, consultations, please set up meetings with us through Zoom sessions. They're pro bono. If you want specific advice, we'll give you industry or specific to your business advice, from legal to accounting, various consulting services, IT and the like, and that's part of the pro bono service. So bear that in mind. It's pro bono. It begs the question, why wouldn't you join COBRA? And when I say join COBRA, COBRA is not about business rescue. COBRA is about avoiding a business rescue for distressed businesses. The idea behind COBRA is to negotiate arrangements between debtors and creditors. Debtors and creditors at the moment are understanding, as every creditor in turn has other creditors who are applying pressure. So everybody's understanding, and it's not the classical case stigmatized type business rescue environment. This is an environment where business rescue is being considered in circumstances where a creditor is applying pressure. So what happens is COBRA will put you into business rescue to deal with the creditor, to level the playing fields in a sense. But we've found that that's very rare. It hasn't been required. What we do is on Mondays, we give a general overview on business rescue. And one of the aspects that we cover is the notion of post-commencement finance, PCF as it's referred to. And PCF is another reason that we give as to why business rescue may be advisable, but it may be advisable in the absence of a creditor applying pressure. And that's kind of really where we're going today, because we have now these targeted webinars where we look at various aspects of businesses in distress. And the legal framework, I'll kick off with, just so the audience understands, and welcome to the audience if I haven't welcomed you. We have an audience on Facebook, YouTube, and as part of this webinar. So PCF is post-commencement finance. The idea is, if a business is in distress, it's obvious, it needs money, and that's why it's in distress. And there are lenders who are quite prepared to lend money as PCF, and there's a reason for that. And the reason is that if you lend money to a business whilst in rescue, the lender gets super preference. So it's a means to actually structure a transaction to ensure that the lender is afforded additional protection. If the super preference is given against a secured asset, that security ranks above SARS. In fact, SARS challenged it in a matter and lost. So the super preference is vital. So now what happens is we have businesses, Nuecapital are in the business of raising such funding. They are not in the lower league, but more when we're talking capital raising for the bigger businesses. Now they'll come in and they'll look at a business in distress, and they will put together a deck, and they will work with the business in raising the capital. And the idea is they go out there, and as part of the structuring, they can look at business rescue to structure. So lenders will have more of an appetite to lend money in this environment because of the super preference. So in a sense, there's an advantage in a company being in distress if it needs money. So it sounds a bit contradictory, it is, but rescue is sometimes used in circumstances where it's just about the funding. And you can have a rescue on that basis, a very, very quick rescue where you go in and out of rescue for the purposes of the structured finance, where creditors are not applying pressure. So to introduce my panelists from Nuecapital, who firstly will be dealing with the following topics. How are different classes of investors changing their approaches to investments in South Africa? Secondly, what types of business will attract funding? Thirdly, what are the implications for stressed businesses? And fourthly, how does that affect post-commencement finance for BRPs? They'll be providing guidance to anyone who's seeking mid-market capital in a stress situation, whether listed or unlisted. So that's what I mean. That's where they're coming in. Now we have, at COBRA, we have advisors who actually advise at a spaza shop level, and they're assisting like you cannot believe. So they're at that level all the way up. So now we're dealing with a different tier of business. We're dealing with that tier where monies in the tens of millions is required. And I'll be most interested to hear what insights they have in that regard. So to introduce them, Mark Taylor, he's a former senior executive at Richmond, Remgro, and head of investment evaluations at Venfin Banking. Trust company and he has trust company and family office experience with Investec and its associated businesses. He has hands-on turnaround experience as a CEO, licensed senior business rescue practitioner, development first aquarium in Turkey. He's a former chairman of AIM listed company. He's an attorney, has an HTIP in maritime law, and the list actually continues. Super impressive. And when I say the list continues, it does. I'll move to Barry Hawke. Barry is the head of equities and valuation at Nuecapital Africa. He has 24 years experience in the equity capital markets and corporate strategy consulting. Career roles that are held, he has been head of Nedbank CIB markets, research and equity markets, and institutional equities based in Johannesburg. That was between 2014 and 2018. Between 2002 and 2013, he was managing director of Holt EMEA, Credit Suisse Equities, based in their London office in the UK. And prior to that, he was a strategy consultant and co-founder of Fractal Value Advisors, also based in Cape Town. And he holds a degree at BSc, Agriculture MBA, and he's a chartered financial analyst. And again, the bio continues. And finally, from the Nuecapital side, we have Gordon Bell, debt, equity, and operations experience he has in African real estate. I'll be very interested to hear his insights. Executive positions he's held in credit, property, and trade finance at Investec, Nedbank Corporate, and Barclays Africa. Real estate operation positions at Octodec and Roll Africa. He has an MBA, strategy and finance, a BSc in construction management. And a little known fact I've got here, Zigzag once featured a shot of him surfing on the magazine cover. And I'd like to know why. As part of my preparations, I don't have that photo to put on the screen. I'll address that later with the team. So the other panelists that we have today, we have Tasneem from Schindler's Attorneys, Gary Barachovitz, Schindler's Attorneys. We have Emma Marseille from IQ Business Group and Artisha from the IQ Business Group. I mentioned earlier, there's the partners, I think I mentioned, were Engaged Business Turnaround, who formed COBRA, and IQ Business, who formed COBRA. So I'm going to hand over to Nuecapital to take the stage. This is a webinar, so if you have any questions, we call upon questions because it is a webinar. Otherwise, we could pre-record them and play them. So the idea here is that you do engage, and we ask that you engage. You can engage anonymously if you feel that you'd have more courage in doing so. But just ask a question. If you can find one question, at least one, that would be most grateful. It's really about the questions. So I'm not sure which one of you is going to kick off. Will it be Mark, Gordon? Mark, okay. Thanks, Mark. Over to you.
Super. Thanks very much, Maurice. Really appreciate it. I think perhaps just to say what we want to try and achieve in this conversation today is to introduce you to some of the ways in which investors are thinking, because it will impact the way in which you deal with a stressed environment. We have some ideas about how you might go about that, which we can share. And then we also want to look through some of the sectors in the market that we think are important to be thinking about. And we'll explain why we think they're important, because these are the ones we think will actually attract investment. So briefly, and thank you to Maurice for the introduction. Briefly, Nuecapital Africa is like a Tinder for African capital. We don't deploy our own capital. We deal with a network of investors that we have attracted to look at transactions in Africa. We're focusing right now, obviously, on South Africa, but we do reach across Africa. And we typically talk to investors who are looking to invest between 50 and 500 million rands into South Africa. We talk to investors on a very discreet basis, have very warm relationships with them. We then help people who are looking to raise money to reach out to those investors, but we vet the deals first and follow a process to make sure that we're not putting nonsense in front of the investors, because at the end of the day, if we do that, we lose credibility. So it's very important for us to make sure that we act in a neutral manner, and we see the world in a very different way. We actually don't provide advice. We are really just a matcher. We're not allowed to provide advice because we're regulated in the UK by the Financial Conduct Authority. But we work very closely with advisors, whether they're your accountant. We are able to help directly on finding debt. But typically, if you're working with a corporate finance advisor or the business rescue practitioner, we're able to work with them. Just to perhaps give you a little bit more of an idea, maybe I should just, if I can, just share my screen with you. Is that okay, Maurice?
Yes, please do.
So perhaps just to walk through the is that coming through now? Right, they're coming through there.
We've got it. Yes, perfect. Thanks.
So just to say, the first thing that's probably worth mentioning is that, as I said, we are registered, we're regulated. We reach out to about 280 investors across the world who look at investments of the size I described. What we're about to say may relate more to the bigger transactions, but much of this is, we'll give you the nuance when we deal with smaller transactions as well, because many of you will not necessarily be looking at this kind of size transaction. But our investor base spreads across the world, and we have offices as well in Australia and New Zealand. Most of our African investors are located offshore, but there are a good number onshore. And you'll see that we reach out to debt, equity, and hybrid investors, credit funds, family offices, private equity, DFIs, sovereign wealth funds, banks, the lot. So we speak to anyone who wants to write checks in Africa. A bit of a sense of what we do. I mean, in 2 years to the end of last year, we looked at 529 leads. We vetted 223 companies. We made 31 proposals to help raise capital and only engaged eventually on 14. It gives you a sense of how strict we try and run our process to make sure that we are just putting the best deals we can in front of investors. And that 14 deals, it represented about 2.5 billion rands of capital. So they are at the bigger end of the market. Nevertheless, we'll take you through some of our thoughts. The first is in a stressed business setting is that private capital, we operate in a private capital market. So a lot gets written about the listed markets and what's going on, but very little about the private capital markets because they're not liquid and very little information is known about these markets as a general rule. We do work with listed companies, but we're raising private capital. We would never raise public capital for a listed company. We deal with the rapidly changing investment markets. I'm going to walk you through my perspectives on that shortly. The stressed versus distressed is an important issue. When you're, we would say to you that every single company on earth, just about, is in a pre-distressed state, or and most are stressed. So we think the difference, obviously, if you're distressed, it means you're having to go into business rescue practice. You use different language. Your shareholders and your directors have to use different language. But we are talking about stressed and distressed in this conversation. You find that most turnaround specialists are extraordinarily good at doing turnarounds. They understand business rescue, but they're not normally very dialed into the capital markets in the private sector like we are. And so, although I'm a senior business rescue practitioner, I don't practice. I don't compete with the business rescue practitioners and the advisors. We simply provide a service to them to help them find capital. We have great credibility with investors, and it's a key issue that we find when we're dealing with investors is to make sure we're open and we're clear with them when we talk to them about what the status is of an investor. And we can be very confidential if the transaction is pre-business rescue. So if someone's in trouble, I don't want anyone to know, but they want to reach out to the market, we're very, very good at doing anonymous raises and without embarrassing anybody, because as we all know, as soon as someone knows you're in trouble, your creditors demand the money, your suppliers refuse to pay, and it's just a disaster. So I've been on the receiving end of that as an entrepreneur before, and it is a truly horrible place to be. Just going back then, sorry, let me just take us to the, I wanted to walk through firstly the difference between strategic and financial investors. A strategic investor is someone who wants to own a business because they want typically to run it, and they feel it adds value to their own business, versus a financial investor, which might be a bank or a private equity fund, where they make an investment typically just to seek a return. Now, there are some very good financial investors, very active ones, but they don't look to run your business. Strategic investors are looking for acquisitions or mergers. We typically talk to financial investors, but when we're dealing in distressed or stressed situations, we then tend to talk much more to strategic investors, because normally they're the guys who can move the fastest. They understand what you're trying, what's going on in your business, because maybe they compete or maybe you supply them. So that at that point we talk to strategic investors. But my main comments are going to embrace financial investors. So if I may, I'm going to just unshare that so that I can. You have instead of just a straight slide, you can see my face. Maybe that's a bit lighter. I think the first thing to say is that in dealing with mezzanine funds, normally we would say to people who are raising growth capital, mezzanine funds are going to be really important, a piece of the capital stack going forward. And so a mezzanine fund is someone who they invest debt, but they take a higher risk than the senior debt provider. So for example, if you've got one of the big four banks that are lending you money, a mezzanine funder would take more risk, so they would subordinate their loan to the senior bank debt holder, and they would take the hit before the bank took it. They would look for more security from you. They might look for second material bonds over property in your business. They might look for sureties, but they take more risk. They charge higher rates. And the way they charge those higher rates can vary. It's either a higher interest rate, or else they charge a higher rate based on the fact that you are looking to that they maybe want a piece of your business. They might want to own a piece of it, take an option, or have warrants over your business, and that gives them the opportunity to have some upside if they're successful in supporting you. And in mezzanine, what we've seen is, although the interest rates in South Africa have dropped, mezzanine investors have not changed their required rates of return because the market's got more dangerous. They are looking for more stringent security packages at the moment, but they can move fast, and you don't have to have difficult valuation conversations with them. They'll look at your business. They want to know there's a liquidity event, that you will sell the business down the track, or that you will return to profitability. but it prevents you from being diluted out of your business. And that probably works better in a stress situation than in a stressed situation than a distressed situation. Once you get into distress, they probably move out of the picture. Then we move on to banks. I was going to talk about banks, and the banks normally, if I'm talking to investors who are looking for growth capital and they're not in a stress situation, I would say to them that the banks are typically no longer in the market. They're not looking to put money, invest further money. They're regulated. They've been instructed by the Reserve Bank they have been requested by the Reserve Bank not to pay out dividends to maintain their liquidity. And as a consequence of that sort of pressure, because they are important economic actors in the business community and the financial ecosystem as a whole, they are prohibited from taking wild risks. So you will see them retreating from the risk market. They will be looking after their own balance sheets so they don't fail. They will be looking after their existing clients who have problems, but they're not typically looking to make new investments. What that means is that in a stress situation, you want to be talking to your bankers. They suddenly actually become the most important investor you have if you're in distress, because they have something to lose. As they say, you know, if you owe your bank 500,000 Rand, you don't sleep at night. But if you owe them 500 million Rand, they don't sleep at night. So these are the situations where, from a distress perspective, obviously your banks become very important funding partners if you're in distress. If you're in pre-distress, you really want to be talking to MES funds, I'd argue, and not wasting your time with the banks. They won't issue new loans. There's a number of government-backed initiatives at the moment, guarantee funds and the like, and what we'd say about those is they're really just to help you survive, but for a short period of time. But they're not going to provide you with survival money forever and a day. The private equity funds, we're seeing some private equity funds are moving into the distressed market. There are very few distressed players. There's in the market who are dedicated distressed players. Most of the distressed funds are either fully invested. There's a good Section 12J fund that operates at the moment that is less than 50 million. We don't typically deal with them, but there are funds out there doing distressed investment, but very few of them. Some of the private equity funds that have looser mandates are able to pick up distressed work, and you'll see them active in the market. And it's probably worth noting we have seen some moves by some of the private equity funds saying to us, you know, the crash hasn't happened yet. Now that's a disturbing thought. And we know that Warren Buffett famously said quite recently after he retreated from the airlines, he was asked why he sold at the bottom of the market. And he said, that's about a week ago, he said, call me in 6 months and let's discuss whether it was the bottom of the market or not. So these are quite disturbing situations. So some private equity funds are sitting on your capital, but there are those who are investing in distressed situations. Many of them are more likely to be funding their portfolio companies who want to acquire businesses that are in deep distress. I would talk to you about DFIs, the DEGs, FMOs, the OPICs of the world. These are the big governmental organizations that invest from overseas into Africa. They're probably moving too slow. They're probably not going to be able to be of much support to emergency situations. They're better for a more strategic growth capital. And I'd say the same about the sovereign wealth funds. These would be Middle Eastern funds, perhaps who've made money in oil. Norfund in Norway, you know, there are funds out there, but they are probably much less likely to be able to operate quickly in a distressed situation. And then finally, the family offices. So we deal with high net worth individuals. When a high net worth individual has their own office with professional people running it, a CEO and a team around them, we would call that a family office. It's not a rich guy at home with an office. That's not a family office. It's a very structured organization often with very deep generational wealth. And these are the places where the opportunities are going to be for investment are really important. So I would say that in where you are moving below the 50 million Rand raises, you would be talking to high net worths. So these will be people who maybe can place 2, 3, 5 million Rand into an investment, who have appetite and understand your industry. These are the guys who are going to be really important if you know them, if you can find them. and they tend to they tend to have a very good understanding of how entrepreneurs work because they've either been entrepreneurs themselves or their families, people in entrepreneurship. So that perhaps gives you a sense of what we've seen in the market with investors, depending on whether you're in a stressed or distressed situation. I'm going to actually ask Barry to take over and maybe just talk through some of the sectors. So before he does, just to say that we've taken a medium-term view on this, as Barry will explain, not a short-term view, and try to identify those businesses which we think are going to come out of COVID-19 successful, profitable, and if they've got great management teams, they've got great economics, investors are looking at them. If they have lousy economics, if you've got a lousy management team, you're not going to raise money, to be blunt. If you've got a great management team and lousy economics, there are probably better routes to go than trying to rescue a business right now. We would argue as a broad statement, and those that have got great economics, great management teams that could go insolvent, those are the ones we probably feel for most, and Barry's going to try and identify those sectors for you. So I'm going to switch off and hand over to Barry.
Thank you, Mark. Yeah. So what happened is we had a lot of inbound requests for funding, and some of them from quite different types of businesses and situations. And we ended up starting to compartmentalize them into sectors that were broken, those that were likely to survive, and then those that were likely to thrive. And that obviously would characterize the types of investment appetites our investors would have for each of them. And we just started building these lists through a series of discussions. Gordon got frustrated with this long-winded definition of broken, survive, thrive. So he just ended up saying, let's just call them the good, the bad, and the ugly. And that name's sort of stuck, and we hope Clint Eastwood will be proud of us. I'm actually going to share my screen. So if it's okay, I'm going to actually go through those lists, and hopefully you'll be able to share to see these. So I'm going to start off with ugly. So these are broken businesses that require quite a substantial rework to their strategy and existing method of operation in order to actually make it through this. The first on the list is property. So I'm going to ask Gordon to talk us through some of those before I carry on with the rest. Gordon?
Thanks, Barry. Thanks a lot. Just briefly on property, I think we need to be aware that before COVID, the property industry was actually in deep trouble. If you looked at the REIT prices, that's a real estate investment trust, the listed sector, it was in trouble. I mean, values had fallen significantly on some of the bigger, even more blue chip REITs. And you know, that was because of the uncertainty around land expropriation without compensation, and also just poor economic conditions. Tenants were under pressure and rentals were under pressure as well. And I think also when you speak about property, it's very difficult to give a one-size-fits-all statement. You know, property is a very segmented industry. It's segmented. You've got retail, you've got industrial, you've got residential, you've got commercial and office. Plus within those various segments, you've got different subcategories. And then you've also got geographical segmentation in different areas or different zones. And then even within those geographical segmentations, you've got micro locations, the actual location of the property within that suburb or within that particular industrial area. So, you know, when I give my comments, just bear that in mind, that you do get exceptions. I mean, for example, if you've got a piece of real estate in Clifton, you're probably not going to experience too much decline. There's still going to be a queue of buyers for that property. Just where they source from might be different, that's all. You know, so if I make a comment like the residential market's going to be under pressure, it's not universal. It applies to most areas. But if you look basically at commercial offices, and I'll go through the quick segmentation analysis that we did, you know, your tight desk configurations are going to be under scrutiny, and the configuration of offices is probably going to be looked at more closely. Having said that, I don't think, you know, with the less densely sort of packed offices, I do think that office buildings, new ones that are going up that are vacant, are not likely to be filled in a hurry, because people in the trend to work from home and to conference like we're doing now has increased substantially. What I do see an opportunity for is you get firms that call themselves CREST or corporate real estate services, and they give a service offering where they give you layout and design and tell you how to design your pause areas and your canteen areas. Those firms could do quite nicely as professional advisors. And I think that particularly those who are able to leverage off international best practice. If you look at retail, retail is not going to disappear. You know, we've already seen transitions within the last 10 or 20 years from high street to shopping malls to big box value centers. and finally now to online shopping. So most retail centers, we believe, will continue to struggle, and it's going to be very tough going forward, particularly when landlords are trying to digest or they're trying desperately to attract tenants. Tenants are going to come in, they're going to struggle to get through that J-curve of initial trading. They're going to ask for rental concessions, quite rightly so, and they're also going to ask for tenant fit-outs, to assist them. So it's going to be particularly tough. What we are seeing from where we're sitting is quite a few payment solutions coming to market, and we think that could be a very attractive feature. Different ways of paying your account, or different card mechanisms. And we think the tenants who can embrace those different payment solutions and have a very strong customer orientation are going to probably survive the best, and probably be the best line shops for tenants to have. But we definitely see it being a tenants market for the foreseeable future. If we look at industrial, now logistics premises, you look at an area like Midrand, or you look at the areas around Durban's airport. There's some beautiful logistics premises that have gone up there, and there's certainly been a spike in demand during COVID. And we think after COVID that even post lockdown, I should say, not after COVID, the logistic premises will continue to be in demand. If you've got good circulation space, that typical 12-meter slab to eaves clearance, good technology is critical going forward as well, and good energy provision. Whether it's renewable, or whether it's just efficiency in that aspect will be very important. I do see, and we have seen over the last few decades, that your old industrial premises that were styled around a particular tenant, say a textile business with different shapes and designs of buildings, those become very costly to reconfigure and repurpose, and also very efficient, because you don't always get the space configurations that you want. So we suspect those will continue to be difficult in the market. Residential is very, very, very segmented as well. I mean, you get residential, you get affordable housing, you get high-end housing, but essentially those, and you get the rental market as well. But basically those landlords who could demonstrate a disciplined tenant retention strategy, and also a professional approach to managing large tenant volumes. And they've got a dynamic and empathetic tenant retention model. They'll be the ones to survive best. And then just student accommodation. I mean, I have a daughter at UCT, and I'm beginning to wonder if it's a good idea to have my daughter at a remote university, because increasingly the universities are now doing their learning by distance, and doing it through technology. And that will continue. Estate living and retirement facilities, I believe, will remain popular, but their success is very much a function of their micro-location and the facility offerings. But I think what you need to know, what we need to remind ourselves of, is that the consumer is going to be hard-pressed going forward for some time to come, and it's not going to change in the short term. And then if you look at the sub-3 million market category, 3 to 5 million market, there's going to be a pressure on purchases in that market, because there will be a tendency rather to rent, because getting bonds is going to be quite tricky. Banks at the moment are quite slow with their credit processes, or probably will be going forward, and understandably, they're looking over their shoulder at their non-performing loans. They don't want any more. Banks don't like foreclosing and taking in properties. It's not their business. So they don't want to be doing risky loans in the market for the foreseeable future. And then if you look at hospitality, hospitality is a much publicized sector that's one under strain. We understand why, because travels become challenging. You don't particularly want to go to crowded venues. So obviously venues, and we've sort of identified that bush lodges, well-managed bush lodges, where they can actually demonstrate a level of discretion and good management. Typically when you go for a game drive, it's an immediate family in a car, or you're in an open bush venue, an open bush vehicle. And even the dining facilities, they tend to be outdoor focused. And the premises, the whole theme is on distance and being unobtrusive. We think they might have legs. I won't say there'll be upside, but in the diminishing market, they could still get some interest, And if you're doing a company strategy session, a bush lodge will be a very attractive venue, as opposed to one of the big crowded venues. Then just briefly on sub-Saharan Africa, I mean, I could spend all day talking about this, but briefly, the challenges that you have there are liquidity, corruption. We've never heard of that in South Africa, but it's present in the entire continent, and in South Africa particularly. and also infrastructure. Infrastructure is a big challenge when looking at property in Africa. And you know, essentially, if you are looking at African property, it makes sense if it's part of, if you have a mandate to invest in property and it's part of a geographical diversification strategy, that's great. But I can assure you that most property in most African countries is sweating, and that's pre-COVID. Vacancies are high, arrears are high, and you know, you don't get many big box tenants in most other countries. Just to give you an idea, I mean, the Kenyan economy, GDP, is probably 1/3 of South Africa's. So it's growing off a relatively modest base. And even Nigeria, who boasts a very competitive GDP to ours, it's spread over a population probably 3 times the size. You know, if you look at Nairobi, their stock market is $23 billion. The JSE is roughly just under $700 billion. I haven't looked at the latest market cap, but these economies aren't that big. And as property operators are going in there, particularly retail, they're realizing, oh, it's not quite what they thought it would be. So that's an overview of property, but it's a whole separate discussion. But thanks, Barry. Thank you very much.
So if I could just rifle through the rest of the list without going into too much detail. Aviation, international specifically, we heard a lot about that. In fact, some of the data miners in the US have looked at spending patterns first 2 months of the year and then March, April, and there was some 90% reduction in the spend on aviation. Business travel, business accommodation, hotels, no pushback on that. Cruise ships, and the Petri dish effect, which is actually quite gross if you come to think about it. Entertainment and the arts, specifically venues where there's a high density audiences. Cinemas, attractions, casinos, same type of risk, and people don't really want to become part of that transmission chain. Conferencing, Gordon mentioned that. Printed media, we've all been reading our news online. We don't need to go out and buy magazines and newspapers so much anymore. Automotive, cars. So if there's pressure on consumer spending, that's going to reduce the appetite for that. But also, if we're not driving to work and we're not traveling around as much anymore, maybe we don't need 2 cars, maybe we don't need 2 fancy cars. Clothing and textiles, and specifically non-essential and fast fashion. If you're going out less, you don't need to have such a big wardrobe. Public transport, there's infection risk around that. That may not be as applicable in our market, but people may want to reduce their exposure, and obviously staying with public transport would be one key area that they could be contaminated. Call centers, high density in South Africa, that was one of the first to feature as potential infection risk areas, so they need more spacing to spread themselves out. Online bookings have had a lot of issues in terms of the way they control that process, they control the cash, are they able to offer refunds, and a lot of people I think will have lost appetite with using many of those and maybe move directly to the venues themselves. Construction, large scale, this has been a bit of a contentious one, but if there's reduced project funding and also if there's changing government priorities, you may see that under a lot of pressure as it has been for a long time. Luxury goods, specifically in the mid-market, tourism and leisure, that's I think stands out as having happened, and that's specifically international. If I go to the next slide, so now we look at bad business model. Businesses that should survive, but they're going to need to reconfigure themselves, and there may be portions of their business that are looking attractive. So clearly this list has become a little more of an attractive sector for funding as opposed to the broken ones. And there's some fairly broad categories here. Manufacturing, so there's been a lot of supply chain scrutiny, demand destruction, and workplace hygiene would be under the looking glass. And then under education, you may be able to supplement that with online education. I think people will be looking at how that's all working. Gordon looks like he's going to be pulling his daughter out of UCT and back home again. Energy, there's potentially more pressure for alternatives, but it is going to be dependent on that oil price and grid parity. Mining, you'll be looking at hygiene and work in the working place. And then also demand for products. If international commodity prices are down, that could be difficult for them. Industrials, value chain, digitization is going to be a key thing. Digitization across most businesses. If there's opportunities, you should embrace those. And then there's also supply chain dependencies. Packaging, there's an opportunity to shift towards more health and hygiene. And then there's going to be a growing environmental concern. Agriculture has been very interesting. So some of the large-scale agriculture that's relied on big markets may fall under pressure, but we'll see this come under our Thrive list again. We'll talk a bit more about it there. But there will be probably a shift towards enhanced food security as well. Mid-sized construction should be good, especially smaller projects and the need for more flexibility. Financial services, you've always seen large institutions slow to move. Dislocations in the market like this will not be very good for them, and the potential for further disruption from the fintechs should probably enhance. Insurance is quite interesting, and specifically long-term insurance, life insurance. There will be policy lapses as people have pressure on consumer spending, but you do need policy growth in new business for the life insurance businesses to remain viable and keep their valuations up. So that could be a bit of a challenge. And then within the markets, you've got an asset liability mismatch that may have opened up given how much the stock markets did correct. So that could result in a bit of problems on the way they fund themselves. Traditional banking, there's going to be a switch to online, a lot of pressure for contactless, any sort of lower cost de-risking. Entertainment, live sport does seem to be at risk. There's been empty stadiums. I mean, they're trying, I think the Bundesliga had football matches this last weekend. I think they had some 16 or 17 million viewers. But it's going to be tough to continue to retain that with the atmosphere and the stadiums gone. I don't know how that's going to shake out. And then related to that would be above the line advertising. It's going to be tough to have those concentrated sources of capturing your attention, and then how do they manage to retain that from live events, etc. Apparel retail, so there's pressure on discretionary spend, more functional clothing. Rental accommodation, Gordon mentioned. Hospitals, there's going to be diminished profitability from those high volume facilities. Private healthcare, I mean, who would have thought in a health crisis you would have private healthcare in such a dire situation? But yeah, you see the volume model seems to be broken, and you've actually had them being forced to halt all the elective surgeries. So that's put them into a really difficult position. Call centers, you need an effective distributed model. Restaurants and bars, quite a contentious one, and it's going to be quite specific which ones will come out of this surviving, but certainly those crowded, high density ones are probably not going to be at top of the list. People are going to be wanting to have more distancing, and they'll be part of that transmission chain. Gym facilities, also hygiene, client concentration, transmission services will be a challenge for them. Ride sharing could actually do quite well. Uber and electric cars, as people say, well, I don't want to take public transport, I'd rather share rides, maybe I've got a better chance of sanitizing myself in that situation. And if I'm driving into the cities, etc., maybe I'll actually get an electric car as opposed to take public transport. Luxury goods, ultra high end should survive, but the mid-market should be at risk again with consumer spending. Now, if we look at the goods, so this is businesses that should thrive. We need to feed these businesses in terms of the resources that they need, whether it's funding or anything else. Hospital, medical facilities, specifically bespoke specialist facilities that are distributed and hygienic, flexible. Medical supply and services, it's adaptable. Supply chain integrity, logistics, scientific research, specialized medical, personal health care. There's not too much pushback on where these are going. Nutraceuticals, there's going to be a trend towards healthier foods and supplements. A general category that's done very well out of this is information and communications technology. So that's an overall winner as we're all digitizing, networking, relying on bandwidth and using the remote office. If we look at e-commerce and online trade statistics in the US, the overall retailers in the period, those first 2 months, the second 2 months, saw sales go up about 10%. This is the food retailers. But the online food delivery was up 4 times. That's 400%. At the same time, apparel was down 60, 70%. So that's a big switch, and I think it's going to become a revelation for all of us. Data connectivity, we're looking for cheaper data. We're looking for bandwidth optimization, simplified solutions. You've got Rain coming into South Africa with their 5G networks. You've got a lot more competition, and that's going to be good for all of us, but there's going to be big pushes and demands for that. Telecoms and networking, anything that helps with connectivity, the rise of the home office and distributed businesses. Streaming technologies, in terms of movies, etc., we substitute away from maybe our satellite TV. And then online gaming and gambling, big ways, big time. Esports maybe taking over share from the traditional live sports. And then online video conferencing, just as we're doing now. We've been doing tons of it. And on the subscriptions for services like Zoom have just skyrocketed through this pandemic. Fintech, contactless payments, 3D printing. There's been demand for distributed local manufacturing facilities, and that's great. So we should hopefully see more of that. Semiconductors, tech hardware, also in line with the rise of the home office and the distributed workforce. And then the retail and the high street. There's a few more items here, a bit more on the retail side, high street and food. Then we've got food and convenience, should do well. Food processing, agriculture, local niche. So people are looking at where they're sourcing their agriculture from. They're cooking at home more, but like to source more local produce. And also it's actually proved to be a very stable sector. It hasn't lost a beat during the pandemic. They've continued to produce. Demand for their product seems to be going up, and they're actually looking much more bankable than they might have been before. At the same time that their traditional sources of capital, maybe the land bank or the big four banks, have been holding back. home delivery, logistics, online education, seen a boom, content creation, sportswear, the trend towards more health and fitness, comfortable stay-at-home clothing, and then online exercises are taking away share from the Pilates and yoga studios and other gyms. DIY and home improvement, we're spending more time at home, we'll fix up where we are a lot more. Remote living, so there's a trend away from the cities. We can actually get away with moving to the country as long as we've got infrastructure and connectivity. We can run our businesses. And then alternative energy to fuel the home office and have a more reliable source of power. And low density experiential tourism, so nature travel, game reserves, camping, where you can actually retain that ability to engage with nature. I think people are becoming more aware of that, but at the same time, not have the infection risks that you might be associated with. So I think the point being is, depending on which of these categories is going to depend on your attractiveness for sourcing capital, but also how you should present yourself. A very useful framework, the Herself-Craker Jumpstart framework. So if you are in those broken or surviving categories, you want to think about JUMP, which stands for jettison, uplift, mothball, pivot, and then of course potentially start something new. An example of mothballing, maybe these high-end game lodges, they're not going to see travelers for the next year, but there's going to be demand for those. I think everybody agrees with that. Just need to find a way to get there. So if they can sit out and maintain their facilities, there should be something at the end of the tunnel. Another framework also worth looking at, there's a lot of information on the McKinsey website around COVID-19. They've got their 5 Horizon framework where they talk about resolve, resilience, return, reimagination, and reform. And it's quite a useful way of thinking about how your business would structure, where you would need to target your short and medium term strategies to actually get yourselves back on the road again. I think that's pretty much it for me. Mark, I don't know if you want to take on the next slide. I see there's also quite a few questions that I'm going to. Do you want the slide up, Mark, or should we take on some questions?
Let's take see if there's any questions, because we can just the slide I have is really just a sort of wrap up slide and some thoughts. But do we have any questions that we need to answer right now?
I certainly do, if I can jump in. Sure. But before I do, so I'm going to be asking Gordon around property, because there's an observation of mine that I'm not quite sure what the answer is. But before I get there, I just want to mention right in the beginning, you went and said that you're dealing with stressed companies, and you made the point of using the term stressed. I just think for the audience to mention that the statutory definition of financial distress in terms of the Act, in terms of Section 128 of the Companies Act, is if you're unable, if you're reasonably unlikely to pay your debts within the ensuing 6 months. So it's a very, very low threshold. And that threshold, if you hit that threshold, the directors actually have to put business rescue to the vote. And if they vote against business rescue, they have to write to employees and creditors setting out that it was put to the vote and the reasons as to why it did not go into business rescue. And those reasons can be the fact that you joined the COBRA ecosystem to try and keep you out of business rescue. So just, Gordon, and this is in relation to commercial property, there seem to be 2 competing forces. The one is technology, where that's driving people to work from home. So we've got technology over there. And then the second is social distancing. So I'm struggling with, are we going to need more office space or less office space, or is it going to remain the same? Because take our offices now at Schindler's. I mean, we can only fit in a fraction, it's not about 40% of the staff that we originally were able to fit in the offices. So now there's the one competing force, which is the requirement for additional space. But then you have the other competing force, which is technology. Have you thought this through? What do you believe which force will trump the other?
You know, it depends. I'm not copying out, but it depends on the particular tenant. I mean, I often reflect on the big law offices in Sandton. They've got those huge premises, you know. Now, a lot of your attorneys like the quietness of the office. They like their library behind them and that professional feel and the interaction. I think technology will dominate. And what you will find is that office space around you might be falling vacant and might be becoming cheaper. And eventually, when it gets to renewal of your lease or your terms, you're going to find that you might spread out into cheaper premises. But overall, the demand for premises, I believe, will reduce. You know, I mean, I've been doing the Zoom calls and operating from a remote environment for some time now, and it works perfectly well. So I think technology will dominate that, is my personal view.
Yeah, and I guess, yeah, so social distancing, presumably, I mean, there's the behavioral economic side of things, but social distancing hopefully won't be around for too much longer, whereas technology has always been there. Did you guys ever analyze the effect of exponential technology? You know, for instance, when it comes to property, I've read a lot about technology pushing property in any event towards ruralization, because we're going to have, you know, the helicopters being launched in Dubai now, which is an autonomous flying car, which they say will be cheaper than an Uber because it has no driver. Now, that would lead to ruralization, and that's as a result of exponential technology. What we're seeing now is an acceleration. Everybody, that's the behavioral economics. Everybody's getting used to it because of COVID. Were we not heading in that direction anyway?
We probably were. Yeah, definitely. I mean, I'm not sure I'd want to get onto a helicopter. You know, I mean, I battle with the roads in South Africa as it is. So air travel to me with a taxi driver or yeah, it's quite a daunting thought. But I do think there is a tendency towards that. There definitely will be. And I think that operating remotely, anything that allows you to operate remotely, I mean, even, you know, if you consider the old Johannesburg CBD, can you imagine if Sandton hadn't have evolved? You would have had this really congested, complete knot, you know, in the CBD. So, and driving to and from work can be very frustrating. You know, you get into that Grayston Drive, Rivonia area, and you just sit for hours sometimes trying to get through. So I definitely believe there'll be an increasing sort of willingness to work remotely and towards technology. But to answer your question, yes, yeah, it probably was happening already. I mean, that's why, you know, I think the whole property sector has been, when I say under review, you know, even pre-COVID, people were looking at property, where it's going. There's a surplus of office space in Sandton abundantly. So, you know, and there's certainly in the CBD, there's huge office buildings that are completely vacant. They've been vacant for decades and they haven't been used or put to alternative use. So there's enough space out there. You know, it's just getting in the right location. And I don't know. I can't see growth in the office space environment in a hurry. Unless you're building bespoke premises for a specific purpose where you decide you need, you know, certain office configurations. But if I consider my office environment, I wouldn't social distance from my colleagues. You know, I'd still, hi, how are you? I'd probably greet them with an elbow knock or something like that. But I'm not going to walk around sort of, you know, like it's a plague environment. People will still reasonably interact. You know, it's
Maurice,
more
if I could just add to that, there was an announcement by Facebook, I think it was just in the last 2 days, that this working from home is working for them, and up to 40% of their workforce. So now it's going to become a permanent solution. So I think it will be, as Gordon said, business specific, but you're going to see we're accelerating our digitization migration by 5-6 years by being forced into doing it from this pandemic. What we were going to do anyway by 2025, we've suddenly done it now. Yeah,
Gordon, where do you, Sandton, 10 years time, occupancy rates, where do you see them sitting at? I mean, will they ever recover? I mean, I'm struggling to actually imagine a world where we're going to need all these offices in Sandton.
Yeah, I can't see them recovering, you know, in the next 5 or maybe even 10 years. I know I'm not, I mean, I understand I'm very objective. I'm not a broker. I'm not trying to talk to a book. I think there's a surplus and it's going to remain there. And I think eventually, as some of the blue chip tenants work remotely, you might find slightly lesser caliber tenants moving in. But having said that, Sandton is, I've always said it's a CBD of Africa. You know, it's a big statement to make, but it really is. If anywhere is going to work as an office node, it's going to be Sandton. So it's maybe not a good example to use, but I do think it's under pressure. But I do think that some of the lesser office nodes, you know, like the Fricker Road area and those areas, you know, where they have experienced vacancies, those will continue, you know, and these remote offices. People want to work closer to home. And I think people are seeing the benefits now. You know, having a dog barking in the background is almost seen as being quite cool now, you know. Whereas before, you just didn't want to hear it. It meant you're working from home. Whereas now it's seen as almost quite quirky. So, yeah, I think certain offices will be under pressure. Yeah.
Gordon, and interest rates, the low interest rates in the lower level markets, the 1 million mark, There's also been quite a bit there. I've read contradictory literature, but there's a suggestion that people are going to start questioning whether it's worth their while to rent, and that may lead to a buoyant market at that level. Do you have any views on that?
It's fine. But as a banker, you're sitting there and saying to yourself, and I used to chair credit committees at banks, so I understand the thought process. You're going to say, gee, what happens when rates go from these low single digits, let's say they get to 5%, and suddenly they go back to 12% or 15%. Suddenly you just flush out all these tenants. And I think the market's aware of that. We realize that this is not a sustainable zone where we're seeing interest rates at the moment. So, interest rates could almost fall as it really depends on the decision makers. The decision makers are the mortgage grantors and their view on it. Individuals might say, gee, I can afford this now. The interest with interest rates down at, let's say, it gets to 5%. This is very affordable. It depends how the banks view it. And if the banks are sitting on huge repo books, or PIPs as they call them, properties in possession, they're not going to be aggressively wanting to lend into the market. They've got a very responsible view, in my experience. And banks do not like properties in possession. It's reputation, it's bad. It's a mission to manage. They're not geared to manage them, and it just becomes a nightmare. Banks like a clean book, and so does the banking system. So they'll be very cautious about lending into, even if rates drop down. This is probably a spike down. I don't know how long it's going to be, how long term it's going to be. And once again, it just depends how long this COVID lasts. We're reaching a point now where literally this lockdown and I support President Ramaphosa's views, but it's destructive now. It's becoming very difficult. But I'm not the one to make the call. Thank heavens.
I see we're almost out of time, so I got a final question from Mark. Mark, you've heard Gordon. I mean, the future's opaque. We just don't know. And if the future is as opaque as we all believe it to be, how does one then advise, or what do lenders look out for? I mean, if the future's opaque, isn't it so high risk that you'll actually find that there'll be a huge reluctance until there's some degree of clarity? So what would you guys do at the moment? How would you be advising? How do you get around the opaqueness?
So I think the first thing is the banks will talk to you if they're threatened and they think they can recover the loan by talking to you. I mean, that was my point, is that if you're looking for new debt, you're not going to get it from a bank right now. If you've got existing debt that's distressed, they will have to talk to you. As Gordon said, they don't like that on their books. I think that the kinds of investors who will have more appetite for longer term for debt at the moment are going to be looking for higher rates. As I said, we haven't seen rates going up dramatically, but interest rates have dropped. So nominally, so in real terms, they've gone up by 2%. We know that. They're looking for more security. So I would say that that's an issue, and then an issue you'd want to consider. To be honest, if anyone tells you right now they know what's going to happen, Morris, they're smoking your socks. No one.
And I agree, and I mean, there's absolutely it's impossible. That's the one certainty we have, is that it's virtually impossible to predict how we're going to come out of this.
And just going back to your definition of distress, I mean, I had a note here on my parting thoughts. One is that nearly every business on earth is pre-distress.
Yeah, exactly.
I mean, there's very few businesses out there that are loving life right now. There's some of them, I get it. There's a bunch of them, but not very many of them. Majority of the businesses discovered that running a lean balance sheet wasn't so clever after all, despite what the business schools told them about capital efficiency. It's a very, very tough environment. We would encourage people to act swiftly and decisively. Don't stop talking to your creditors. Work with experienced and credible advisors. This is my wrap up. Evaluate your prospects realistically. If you're thinking about business risk, you make sure it's not a band-aid, but it's a real solution. If it's not a solution, just liquidate. Think about your own time. This is your stock and trade. Rather start something new. And I will tell you as a little thought, the one thing that we've seen change is how this pandemic has democratized location. If you work in Joburg on one floor and someone sits a floor above you, in the old days you would wander through and have a coffee with them. Right now you've got to Zoom them. You could be living in Timbuktu for all that matters. So starting new businesses, locations become democratized. The other thing is get to the front of your investor queues quickly, because the problem isn't there's a lack of capital. There's a lack of resources in the financiers. They do not have enough executives to handle all the inquiries. And finally, even if you're stressed, still think strategically. You must think strategically about what you're doing and where you're going. And even if that is about your own personal strategy as a human being and whether you're getting the best bang for your own buck in the time you're investing in your business or in whatever you're doing. So,
fantastic. Yeah, thanks for that. Thanks to the panelists. This was a most interesting show. It will be published on our Facebook page. So go onto the Facebook page, the Schindler's Facebook page. You'll also find it on COBRA. And please share it. I've in fact sent a note to my entire management team saying to them that they have to watch this. I mean, as far as I'm concerned, this is absolutely brilliant. So thanks so much, guys. I'm certainly going to make sure that we have you back as things change and as we see development. So thanks, guys. Thanks to the audience. Hopefully we'll see you later on at 3 o'clock today. Thank you. Cheers all.
Thank you.
Bye.
Thanks for having us.